Ladies and gentlemen, you're tuning in to Political Decode. Let's roll the film.
Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number two economy. My name is Tony. I think we have another big week ahead of us. Today's episode also contains this month's sponsored feature. I'm very excited about this particular sponsored feature. Regular viewers will see that it very much ties into what we've been following very closely on China Update. If viewers like to know how I decide on sponsored features, this information is in the description below. But before we look at that opportunity, first up, we need to discuss the economy. So let's jump in. China's central government has injected at least 3 trillion yuan, 408 billion US dollars, in the past 6 months to shore up its heavily indebted local governments, marking a major step in a broader 12 trillion yuan debt restructuring initiative unveiled in November of last year. This move, the largest of its kind in China's history, seeks to manage the country's massive pile of hidden debt, accumulated off the books via local government financing vehicles. The package includes expanding special debt allowances by 6 trillion yuan over 3 years, alongside the issuance of 800 billion yuan in new special bonds annually for the first 5 years. These measures aim to ease the burden of mounting interest payments faced by local authorities, enabling them to redirect resources toward economic growth. The urgency stems from the financial strain that has gripped local governments since the collapse of China's property boom. Previously reliant on land sales to developers as a key revenue stream, local governments were hit hard when Beijing's 2020 restrictions on property sector borrowing triggered a market downturn. Simultaneously, COVID-19 era stimulus spending added further fiscal pressure. We note too that debt and deficits have been increasing since that era too. In response, provinces leaned heavily on local government financing vehicles, entities initially created in the 1990s to bypass restrictions on local borrowing to raise funds for infrastructure projects. While local government financing vehicles operate independently on paper, they are widely seen as being backed by local governments and, by extension, Beijing.
Let me ask y'all something. Do you think it's because of the current events that China's economy is the way it is?
As of early 2025, local government financing vehicles hold 15.8 trillion yuan in outstanding onshore bonds, accounting for over 40% of China's non-financial corporate bond market. Though they have avoided open defaults, many have narrowly met debt obligations, and there has been a sharp rise in missed payments on less transparent non-traded debt instruments. The November 2024 debt swap plan, championed by Finance Minister Lan Fo-an, is projected to save local governments 600 billion yuan in interest over 5 years. The effort has rekindled investor appetite for local government financing vehicle bonds, seen as implicitly guaranteed by the state. As a result, yields have fallen. The average coupon for local government financing vehicle bonds hit 2.46% in Q1 of this year, the lowest in over 20 years. Analysts view the initiative as a short-term relief valve rather than a long-term fix. Many of the massive structural issues remain. Fitch Ratings noted that while the program reduces refinancing risks and improves liquidity, it fails to resolve structural challenges, including the vast pool of hidden debt still lurking in the system. As of 2023, China's hidden debt was estimated at 14.3 trillion yuan, a fraction of the full local government financing vehicle debt load.
Quick question. What happens to China's hidden debt or their debt when they devalue their currency? Is the money they owe now less money they owe? Or is that what it means by hidden debt? Because you devalue your currency, but you still owe in what currency? Please leave a comment in the comment section. And if you haven't already done so, please subscribe to Political Decode, where we try to help decode you, the listener, decodes for us in the comment section of what's being discussed. And please subscribe if you like the content we provide. Let's roll.
And this is an internal estimation. Externally, some estimates are as high as 100 trillion yuan. The implications extend beyond the bond market. Financial institutions across the board, from banks to insurers, are exposed to local government financing vehicles, making their health critical to the broader economy. A collapse in their bonds would trigger a financial crisis across the whole country, with China grappling with weak domestic demand and persistent deflationary pressures, not to mention an intensifying trade war. Maintaining local government investment is essential to achieving its 5% GDP growth target. In essence, Beijing's intervention has stabilized short-term confidence, but the underlying fiscal vulnerabilities of China's local government financing system remains unresolved. The world is going through unprecedented changes. As the US and China prepare for a prolonged Cold War, supply chains are seeing once-in-a-lifetime shifts. Regular viewers know that as part of the trade conflict, China, which dominates rare earths and critical minerals, has moved to block their export to the United States. These are critical to US production and national security. Under the current administration, Washington is moving quickly to bring production of these commodities back home. Indeed, in a geopolitical crisis, a sudden supply disruption could cripple some US industries, including defense contractors. Washington knows this and is moving to change the status quo, meaning opportunities for American-based companies. In times of great change like this, it presents incredible opportunities for savvy investors, watching closely and seeking to take advantage of these changes. And today's video sponsor, American Tungsten, ticker symbol DEMRF, provides such an opportunity. American Tungsten could become one of the first tungsten producers on US soil, after a full decade of no tungsten mining whatsoever domestically. Tungsten's unique characteristics make it indispensable in modern industrial, technological, and defense applications.
You hear that? Time to invest in American tungsten. That's what it sounds like to me.
Tungsten is used in some advanced composite armors for military vehicles due to its ability to absorb and dissipate kinetic energy. However, there are no producing mines of this